Hello, my name is Brian Minogue, founder of Cardinal Financial, and in this video, I'm going to walk through my key takeaways and practical lessons from an article entitled Why Not 100% Equities, originally published in the Journal of Portfolio Management in 1996. So first, I'm going to provide a brief summary of the article. Then I will extend the data from 1996 to today, and lastly, I will tie these ideas into real-world applications for how I invest. As this article was written nearly 30 years ago, at the time a lot of this was either theory or only realistic for institutional investors like pensions or hedge funds. But fast forward to today, and now there are ETFs that allow virtually all investors to put this article's ideas into practice and ultimately benefit your financial plan. So let's take a look at this paper, which is linked in the video description. Why Not 100% Equities was written in 1996 by Cliff Asness, founder of investment firm AQR, who at the time was a director of quantitative research at Goldman Sachs. This paper is actually a response to another 1994 paper which questioned whether college and university endowments with virtually infinite time horizons should invest 100% in stocks instead of a more conservative allocation, like a 60-40 stock-bond portfolio. While Asness agrees with the idea that an endowment likely can take more risk than a 60-40 portfolio, he pushes back on the idea that the best way to take more risk is to invest entirely in stocks. Instead, Asness argues that an investor willing to bear the risk of 100% stocks can do even better with a diversified portfolio. And also, this is shown most clearly when an investor is willing to lever. Asness then goes on to explain how if you want to maximize risk-adjusted returns, an investor should first take the optimal combination of assets, which yields the highest return per unit of risk, or the highest Sharpe ratio, and then second, mix this portfolio with cash to reach your desired risk and return. So first, identify a diversified portfolio with a high Sharpe ratio, and if the expected return of this portfolio is below your targets, borrow or use leverage to increase your exposure to this diversified portfolio instead of offloading diversifying assets and concentrating into the highest expected returning asset, typically stocks. So ultimately, Asness is pushing back against the suggestion that colleges and endowments should hold 100% stocks given their high risk tolerance. The alternative he proposes is to apply leverage to a diversified portfolio in pursuit of those higher returns. One of the issues with concentrating into stocks is you tend to get a far more volatile portfolio, and at the extremes of stock allocations, you're taking on a lot more risk with little added return. As we look at combinations of global stocks and US Treasury bonds from 1996 through 2024, you can see how this line flattens out as you approach 100% stocks. What this demonstrates is how you're losing the benefits of diversification, and as you approach 100% stocks, you're eking out only a little bit more return for a lot more risk. We would like to be much better compensated for this additional risk. So instead of how this curve flattens out, we would like to move as much up as to the right in this graph, similar to the dotted red line. And this is a strategy Asness proposes and goes on to compare to 100% stocks. In the paper, Asness reviews the long-term data used in the 1994 article and points out how stocks outperform bonds and the 60-40 portfolio, but he also notes how this is not an apples-to-apples comparison because the risks are dramatically different. As you can see in this chart, stocks returned 10.3% per year, outperforming the 60-40's 8.9% per year. But stocks also had a risk of 20 compared to 12.9 for the 60-40. So in order to make this an apples-to-apples comparison, you would need to lever up the 60-40 portfolio to the same risk level as stocks, or 155%. Take 12.9 times 155%, and you get 20, the same risk as stocks. The paper adds this levered 60-40 portfolio to the chart to demonstrate how levering a diversified portfolio to the same risk of stocks produces greater returns at the same level of risk. The use of standard deviation as a risk measure is not as straightforward to quantify as other measures of risk, so the paper also goes on to compare some worst-case scenarios for the 100% stock portfolio compared to the levered 60/40. The timeframes are broken into the entire 1926 to 1993 period, as well as isolating the post-World War II era. As you can see, among the worst 1 month and 1 year periods, the levered 60/40 portfolio was actually down less than the 100% stock portfolio, with the exception of the worst year since World War II, where stocks were down 39 and the levered 60/40 declined about 44%. So despite the use of 155% leverage, the levered 60/40 portfolio had less severe drawdowns than the unlevered stock portfolio by 3 of these 4 metrics. To conclude, Asness reiterates how an investor should construct the optimal portfolio, the highest Sharpe portfolio, and then apply leverage in the pursuit of higher returns. But it being 1996, he also acknowledges that not all investors can lever at the risk-free rate. Asness goes on to suggest other ways of improving returns, but that's not the focus of this video. The purpose of this video is to first explain this basic theory of taking the optimal or highest Sharpe portfolio and applying leverage rather than concentrating into one asset or stocks. And second, this video is meant to explain how, although this paper's theory was out of reach for individual investors in 1996, more recent developments in the ETF landscape now allow virtually all investors to put this theory into practice. Before getting into more recent ETF developments, let's first extend the paper's data through 2024 to ensure this theory still holds up. Let's compare the returns of 100% stocks versus a 60/40 portfolio from 1997 through 2024. A similar story has played out since the paper was published in 1996. Stocks have outperformed the 60/40 portfolio, but this isn't apples to apples because stocks assumed a lot more risk. Stocks had a standard deviation of 15.5 compared to 9.2 for the 60/40. And stocks also had far more significant worst years and drawdowns. And you can also note the Sharpe ratio of the 60/40 at 0.64 is superior to the 0.53 Sharpe ratio of 100% stocks. To equalize the risk of these portfolios, we would need to lever the 60/40 portfolio by 70%. The result is the data in the following table. And again, a similar story has played out. With equalized risk, the levered 60/40 has now outperformed the 100% stock portfolio. Not only that, but the more diversified levered 60/40 also had a better best year and not as poor worst years or maximum drawdowns when compared to the 100% stock portfolio. So, the levered, more diversified portfolio was less risky than the unlevered, concentrated portfolio. Plotting these portfolios on the risk and return graph we reviewed earlier, you can see how the levered 60/40 results in a better trade-off of risk and return than concentrating into 100% stocks. So while this strategy was only realistic to institutional investors in the mid-1990s, ETFs are now available to virtually all US investors that allow people like you and me to use this same theory and strategy. Beginning in 2018, ETFs began to be launched that allow investors to employ this strategy. One ETF, for example, is a 150% levered 60/40 portfolio, very similar to the levered 60/40 portfolio from the 1996 paper. Here you can see the returns of this one ETF compared to a 90% S&P 500 and 60% bond portfolio, less the risk-free rate. What this demonstrates is how individual investors can employ this strategy through ETFs. And while, of course, an investor could invest 100% in this one ETF instead of stocks, that's not what I'm suggesting or how I invest. Asness's paper was a relatively quick and simple demonstration of the basic idea that you're better off levering up a diversified portfolio compared to concentrating into 100% stocks. But this is a simple demonstration, and Asness does not suggest that the 60/40 is the optimal or highest Sharpe portfolio. So instead of investing entirely into this type of ETF, an investor can instead use these ETFs as a building block in their portfolios to apply leverage to an even higher Sharpe ratio portfolio. For example, an investor could add more diversifiers beyond stocks and bonds in an effort to combat the risks to these traditional assets, and then use these ETFs as tools to lever up that portfolio. This chart compares 100% stocks to the 60/40 portfolio and to a risk parity style portfolio that includes allocations to gold and managed futures. This risk parity style portfolio has a notably higher Sharpe ratio at 0.8 compared to 0.64 and 0.53 for the other portfolios. So while Asness's paper provides an example of levering at 60/40, that is not necessarily the optimal portfolio to leverage. So this video has admittedly been on the nerdier side of things, but it's meant to demonstrate some of the theory and research behind my investment strategy, which involves combining risk parity style investing with capital efficient ETFs or leverage. The goal with this approach is to aim for the highest returns for the risk we are willing to take, which should ultimately translate into better financial planning outcomes. Thanks very much for watching.